Hello traders, Gary Wagner here. Approximately 3 o'clock in Honolulu, 8 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 4th day of March 2022, and this is the daily report for gold and silver. I apologize that we got this video out a little bit later than usual. However, the events that transpired over the week warranted us paying more attention and lengthening the time of the video presentation. This week was filled with extreme geopolitical tension as Russia escalates its action against Ukraine. The already high level of inflation is going to move much higher based upon the fact that oil prices are surging due to what's going on in Russia and Ukraine, and food prices continue to surge, especially in Europe, where Ukraine is a primary supplier of agricultural products. Gold gained $39 today, over 2%, and is currently fixed at $1,974.90. What is most interesting is, as you know, our first target for our exit strategy was to look for gold on a closing basis to match the high of February, which occurred right after the invasion began. Gold closed specifically at its high, gaining almost $75 from the low on Monday to today's close. That is a net gain of 4.32%. While it is quite obvious that gold has truly been acting as a safe haven asset, so has the U.S. dollar, and this has occurred simultaneously. When we look at the dollar actually had a significant gain today of approximately 0.7%. And I've just put up the Kitco Gold Index, which shows that spot gold actually gained $52.10. However, dollar strength took away $15.70, resulting in spot gold's net increase today of $36.40. All of the precious metals experienced significant gains this week, with silver futures, basis the most active contract, gaining 2.67% and is currently fixed at $25.88.5. However, it has been palladium that has experienced the greatest growth, specifically due to the fact that Russia produces 40% of the annual global production, just touching shy of $3,000 an ounce. We have palladium futures at $2,990. Lastly, the commodity that most certainly will have the most profound impact, taking inflationary levels to new higher ground, is the rising cost of crude oil, gaining almost 7% today. A barrel of crude oil is currently at $115 per barrel. On today's show, I wish to discuss 3 topics. First is a discussion of our current trade. We did send out a trade alert this morning, moving our stop up higher. I'll explain that, as well as our anticipated next point in which we will once again raise that stop. I also want to talk about our exit strategy. And then lastly, I want to discuss our long-term forecast for gold prices. On Thursday, February the 24th, that is represented by this extremely long-legged kind of a doji candle, Russia invaded Ukraine. The market did trade to a low below 1880, but the excessive volatility made me shy away from initiating a position which I knew was a necessary component because I believed that gold would move substantially higher. On Friday, I looked to enter near the low of the day, and I also absolutely needed to have our clients positioned from the long side so that if there was an escalation in the conflict over that weekend, which is what I was anticipating, we would see the market react and move higher on Monday. We entered on the 25th, that was a Friday, and we entered near the bottom of the range at 1893. Initially, we put our stop below this price point, and I believe we have raised our stop now for the third time since entering the trade in only 1 week. The most latest raising of the stop occurred last night when we moved our stop to 1923. We are still long from 1893. So the idea behind trailing stops is that when you have a defined and strong rally where it's more difficult to predict a top, by trailing a stop, it allows you to capture a maximum portion of the overall move. As I said, our current stop is sitting at 1723.60. We also suggested that you maintain your current stop in GLD at 171.80 per share. I believe gold is going to go substantially higher, but what I want to address now is this current leg of the rally. It already surpassed my initial belief that we could find resistance at this double top that occurs at roughly $1,961. It's part and parcel of the tremendous retracement from 2,088 down to $1,780 that occurred in 2020 and concluded in March of 2021. The next level that I really felt was important to watch was that I have stated that I believe we will effectively see a close above the highs achieved on last Thursday, the 24th, at 1974, and we are right up against that currently. What we want to watch for is as follows. If the market continues to trade and for some fundamental reason, some break in the tension, we see any kind of a retracement, that would indicate a potential top. On the other hand, if we see gold throughout next week effectively trade higher and move above this price point, it puts our next target at $2,000 per ounce. This is all based upon technical studies, but a move above 1,975 almost puts 2,000 as a distinct certainty. Above that price point is $2,023. I'll need to compress the chart a little bit so you can see where I derived that from. But in essence, what I'm looking at are various tops as the market came down. This top here occurs at 2023. This top here at 2000. And so if we see follow through on Sunday in Australia, then Monday as we open up in the United States, this price point will most certainly be taken out, and our new exit strategy will move to 2,000. We will act accordingly. Also, over the weekend, we will make the decision as to whether or not we want to tighten up our stop prior to the market opening on Monday in New York or Monday in Australia. And finally, I want to present my long-term view for gold over this next year. We will do this combining Elliott wave theory, Fibonacci retracements, and Fibonacci extensions. First, to the setup. We are assuming that the longest of the impulse waves occurred when market forces took gold pricing in 2019 through the middle of 2020 to the highest point on record, 2088. That concluded our impulse third wave. We then went into a corrective cycle that took gold from 2088 down to a low of $1,678, concluding a fourth wave, which brought us to our current wave. And that, of course, is now going to be subdivided into a 5 count. I believe that we have already witnessed and completed the subcount wave 1, which was followed and completed as the market went from $1,918 down to the conclusion at 1777. The retracement, in essence, from 1 was about a 61% retracement and can be best defined as a compression triangle with a series of higher lows and lower highs. Once completed, we got confirmation as it hit its thrust, in other words, breaking above this line, and we are now in a third impulse wave of a component of wave 5. And this is where the models tend to vary, because the most accepted way to formulate a wave 3 is to do a Fibonacci extension of wave 1, and we use a 1.618 extension of wave 1 to achieve our upper level forecast. However, Elliott wave has 3 golden rules, and one of them is that the third impulse wave can never be the shortest, which means by definition, it could be equal to 1, it could go as high as 1.236 or 1.618. So as we look at the variations of those different price structures, our first target is 2017. It could go as high as 2073, and it could even go as high as $2,165. In any case, when it does top at any of these 3 price points, it will then go into a 4th corrective wave. That is obviously a topic we will cover at a later date. The point that I'm trying to make is, at minimum, there is still a lot of upside potential on this current leg of gold, to a minimum of breaking above 2,000. This has been Gary Wagner wishing you, as always, good trading. Our hearts and prayers go out to those in Ukraine. We will talk to you on Monday for the next daily update and review. Bye-bye.